Hello, everyone, and welcome to this Economics 101 presentation. This time we'll focus on gross domestic product, usually called GDP. So let's get going. So what is GDP? That is the value of all the goods and services that are produced within a region. So you have the GDP for a country, GDP for provinces, etc. And this is usually the preferred indicator of a region's internal economic activity. We also like to look at the strength of the labor market, but typically everyone agrees that the variation of GDP from one period to another is a good or even the best measure of economic growth. So just to put these concepts into numbers here, this is GDP for planet Earth in 2019. This is all in US dollar, just for a common currency. So according to the World Bank, global GDP was close to $90 trillion in 2019. So that's $90,000 billion of goods that and services that were produced in 2019 on the planet. You won't be surprised to see that 24% of global GDP was in the US, 16.3% in China. Japan is number 3 with the 5.8% of global GDP. And you see we are here in the bottom, the red arrow. Canada, very small, 1.98% of global GDP. So Canada's economy is 2% of global GDP. So we are very much a small open economy. So maybe how do we calculate GDP? So there will be one equation here and one only. This is the formula for GDP that anyone who's had an economic class in his life has learned. So GDP, the letter Y, is the sum of consumer spending, C, investment expenses, I, government spending, G, net exports, that is exports, X, minus imports, M. So that gives you this equation here. And this is the only equation that you're going to see in this material. So GDP, Y equals consumption plus investment plus government spending plus the net exports. So that's all good. But how does this relate to the Canadian economy and the situation that we're in now? So in 2019, so this is the last year for which we had good comparable data. So we decided to exclude 2020 because of COVID. But 2019, the size of the Canadian economy measured by real GDP was $2,102 billion. So that's $2.1 trillion in Canadian dollars, of course. Of that, 58% or $1.2 trillion was consumption. After that, you had investments of 21% of GDP, government spending 20% of GDP, and on top, a very meager $1 billion of net export. It's not that we don't export, it's that we export pretty much as we import. More details on that in a few seconds. But first, if we drill down, so consumption, we always mention that now we're in a services society. So Canadians spend more on services than on goods. So 55% of consumer spending is on services. 45% only is in goods. When we look at investment now, so non-residential, so when you think about a business buying a building, buying some machinery, some equipment, investing in intellectual property, well, that's 68% of investments, and 32% is residential investment. So when we buy houses, when we renovate our houses, so that goes into the investment component of GDP. Government spending now, maybe a few categories. So spending is the sum of the following components. So road maintenance and construction, so the infrastructure spending of the government, education, health, maintenance of public order, that's mostly wages. So paying for the teachers, paying for the doctors, the nurses, the police, the armed forces. So this is a large part of the government budget, and also parks and museums and all of the other public goods that we can enjoy. So this is captured by this government component. And finally, the net exports. So as I said, we export $676 billion. We exported that in 2019. We imported $675 billion. So the net is just 1 billion. So that's 0% of GDP, but still that doesn't mean that exports and imports are not an important part of the equation here. So when you listen to us with our weekly reviews, you read economic text, you'll watch the nightly news on TV, you hear about all of those economic indicators. So there's a reason why we talk more about some than others, because they have more of an impact on GDP. So just to put everything in the right bucket here, I produced this list. So consumption, which indicators do we tend to follow the most? First, employment is the most important one. More jobs means more wealth for households and more spending, more consumer spending. Wages, pretty much the same thing, more wealth effect. So that means more spending. Retail sales, we have data on that on a monthly basis to see where people are spending their money. Savings and household confidence, that gives you an idea of the future purchasing power and willingness to spend of households. So very important, two very important factors to look at. Now, when it's investment, so the real estate market, as I said, within investment, you have the residential component. So if people are buying more houses, prices will rise, and if prices rise, people will tend to renovate their houses more. So that's a very important component. Business profits, business confidence. So the ability and willingness of businesses to invest in the coming quarters, coming years. Government, you have the economic cycle. When you are in a recession, the governments need to spend a bit more to sustain the economy, and when you're further along the cycle, the government tends to have to save more. So spend less than they take in, just to be able to have a cushion for when they're needed again. So economic cycle is a very important determinant. Politics, depending on which party is in power or what's the political climate, the budget will look very different. So a very important element to government spending. And interest rates. So of course, most of the government's money comes from taxation, but they also have to borrow on the market. So interest rates is how expensive is it to get some funds. Finally, exports and imports, similar components here. So economic data, exchange rate, and natural resources prices. Exports, we look at the world economy, because this is products that we send elsewhere to be consumed over there. So stronger world economy means more exports, and a stronger domestic economy, that means that we consume more, we import more goods and services, and that leads to higher imports. So that was the all of the economic things to look at. So now what's the link with the markets? Of course, if you're an investor, well, if you see GDP accelerating, what should be the marginal effect of that? Well, stronger GDP growth means that businesses will make more profits, so that should support stocks. Interest rates, more growth means more inflation, so that means higher interest rates. That pushes interest rates higher. And the price of bonds, well, the dynamic between higher interest rates leading to lower bond prices. I explained that in the inflation document presentation that I added alongside this one. So you could go there to look at the dynamics, but higher interest rates, that leads lower prices for bonds. Real estate, it's up arrow, but it's yellow instead of green, because more economic activity means more demand for real estate, but higher interest rates is a headwind for real estate too. So net is positive, but that's less strong than the other asset classes. And the natural resources, well, more production equals more demand for resources. So metals, energy, more of that, more demand for that, so higher prices. So this is the link between GDP, its components, and the financial market. So hoping that was helpful. If you want to follow us, ia.ca/economy, and there you can also access other presentations like these, so that you can have a better understanding of the basic concepts that we discuss often in economics and finance. So thank you, everyone.